South Africa produces 88% of global PGM reserves. So we've got something in the store of value category that nobody else really has. That increase in the petrol and diesel price that you would anticipate is going to have sort of flow through directly into South African industrial businesses, South African consumer businesses. So we're scheduled to spend approximately $740 billion in CapEx this year, and I think there's upside risks to that number. It's the end of the world as we know it, but we feel fine at this point in time. So I think one of the thematics we're going to speak about is AI, and this is a lovely sort of portrayal as to how we think the portfolio is currently positioned. So we're going to speak today about three particular thematics, one being store of value. So those are assets typically with limited supply, such as gold and platinum PGMs, property, and high quality equities. The next bucket is the South African equities, where there is certainly risk insofar as oil price shocks are concerned, but where we remain quite constructive from a valuation perspective, and the outlook is looking quite a bit better than it has been over the last couple of years. And then the final bucket is just these AI beneficiaries. We'll speak to the various buckets within that specific ecosystem or chain that we look at, and then the overriding sort of clouds on the horizon being this geopolitical risk or the tension that we're currently seeing in Iran, which is impacting the oil prices. And sorry, just one more thing in the middle, just the shield is just one of the discussions we had earlier is with respect to hedges, and we do have at this point in time options that are hedging the books to some extent, especially insofar as the US exposure is concerned. So if we do see a material pullback, we would anticipate those options would kick in, the insurance would kick in, and that prevents the downside losses that Al was referring to. So I think just to sort of talk about the elephant in the room being the Iranian war, obviously very topical right now. We want to say, if this is something that is so relevant for us, how is it going to potentially impact our portfolio? And I think this slide encapsulates it fairly well. So the reality is it depends on whether this is going to be a swift campaign or something that is going to be far more protracted. And if we look at each of these buckets that we spoke to a little bit earlier, the store of value category, I think, is something that will continue to be just fine. Probably benefits more in the protracted conflict scenario, because in that scenario, how much are you going to be spending on incremental war budgets insofar as the US is concerned? They've already got this problem with respect to their budget deficits, and their debt burden is just getting bigger and bigger. So at what point in time do the Yanks have to start printing money to go and close the gap? In that scenario, we think certain assets such as gold are going to be very, very well protected. So I think whether it's swift or whether it's fairly protracted, we think it's going to be an asset class that is quite well protected from an investor perspective. South African equities is quite interesting. We were speaking yesterday about the sort of under recovery in the oil price at this point in time and how it impacts petrol and diesel prices. Until 2 days ago, I think the number was close to sort of 8 to 10 rand on diesel on a base of 22 rand a litre. So it could potentially be an absolutely massive shock to the system. I think yesterday when everything settled down a little bit, it sort of pulled back to around 5 rand. But that increase in the petrol and diesel price that you would anticipate is going to have sort of flow through directly into South African industrial businesses, South African consumer businesses. And if it's protracted and the oil prices stay elevated for a long period of time, then we would anticipate some degree of pressure on South African assets. But as we've mentioned a little bit earlier, if one of the main drivers in South Africa, which we'll unpack, is the fact that these bond yields have contracted from sort of 12% a year and a half ago to 8.5% today. And the only asset class that's really responded on the listed side has been the South African property index, which is fairly well correlated with those bonds. The rest of the equities within the portfolio have a fairly low degree of correlation with those bonds, but in theory, much lower long-term interest rates should result in much higher asset prices for those companies. So we do think there's margin of safety insofar as valuations are concerned there. On the AI beneficiaries, if there's a protracted conflict, I think it will be somewhat disruptive to them, but for as long as your your chip manufacturers such as TSMC can continue to source all of the various components to make the chips and the input factors, we do think they will be fairly insulated, and that sort of flows through into the Microsofts, the Googles, the Tencents of the world at the same time. And then the put options, which I referred to, which is that shield, so that's effectively portfolio insurance that we've got. So if it's a swift campaign, the options are going to expire, either the money, it's insurance, and as you would know yourselves, if you're paying a premium to insure a specific event, once that period of insurance expires, they would potentially expire worthless. But that's a great scenario because, as you see, everything else will be up. If it's a protracted conflict, we would anticipate that the put options are going to materially increase in value, that insurance becomes far more valuable for the portfolios in that scenario. So that is something somewhat differentiated to provide some downside protection. And then something that we have also as a hedge been engaging in the course of the last week and a half or 2 weeks is oil futures. So, just to protect some portion of the book, if you buy the oil futures and the price rises, obviously portfolio is going to rally as a result of that. But in the protracted, that's in the protracted conflict scenario. But then if it is a swift campaign and the Americans get out of Iran within the next week or two, that's obviously going to have negative consequences. But again, it's a hedge, which means everything else in the portfolio is likely to benefit, which is why I've put a green arrow there at the same time. So, South Africa, it's a thing I think that is probably most affected by what's going on. So I think we'll start there, but I think the slide basically demonstrates, the GNU has been a really positive factor on the whole. I think it's brought stability to the country, and we really are moving away on the left-hand side of the slide from things like NHI and EWC and very much toward, economic reforms, benefits from breaks from a tax perspective, high investment rates, deregulation, and ultimately prosperity for the people of our lovely country. So the main sort of thrust we want to get across in this slide is to say to you, South Africa produces 88% of global PGM reserves. So we've got something in the store of value category that nobody else really has. So we're fairly unique from that perspective. And that's particularly relevant when you start thinking about all the conversation about rare earths. We're actually quite rich insofar as these rare earths that are not that rare are concerned. But over the last, let's say, 12 to 18 months, we've seen much higher gold prices. We've seen much higher PGM prices. That results in a trade surplus for South Africa. So there's more sort of dollars flowing into the country effectively. The rand is a hell of a lot stronger as a result. Your inflation has dropped quite materially, and the SARB has had the room to cut interest rates as a consequence of that. So all things told, we are still quite bullish that, if these things all do hold, we're going to have higher growth over the next sort of 2 to 3 years. The one sort of bogey in this equation is obviously this oil price. And as we mentioned, if you do have a protracted scenario and the oil price remains elevated, then I think your petrol prices come under pressure, and that's going to stunt sort of the consumption side of the market, and a lot of these low margin businesses such as distributors and logistics companies and companies like that. But as things stand, we have a very positive current account balance. The rand is still 8% stronger against the dollar over the past year. And although the long-term bond has sort of sold off from an 8% yield up to an 8.5% yield, it is still materially stronger than the 12% that we saw just less than sort of 18 months ago. So I think SA is climbing up this ladder at the moment as a result of the high gold prices, PGM prices, trade surplus, tax selections. There's a fantastic story to tell insofar as SA is concerned. And we do think it translates into higher growth, but this Iranian war is obviously the key sort of swing factor that we do worry about right now. So the store of value trade, again, as I mentioned, sort of gold, silver, PGMs, Bitcoin, which I believe is magic beans, not really something I'm too sort of afraid with, high quality equities and land and property. But it's essentially any asset with a limited supply that can serve as a store of value in the event that we have money printing going on by central banks on a mass scale. If you look at what's happened over the course of the last sort of 2 years insofar as gold is concerned, ETF inflows versus the gold price. So the message here is that, across the world, you've seen central banks increasing the size of their reserves. Why have they done that? Well, if Donald is capturing Maduro in Venezuela, he is effectively cutting off Russian oligarchs from their money. He's now into Iran and potentially, we don't really know what the objective is over there, but you can see from a central bank perspective around the world, it doesn't really make a hell of a lot of sense to own US debt as a store of value where they could potentially just renege on their debt. And you've seen massive buying from central banks all over the world, as well as certain financial flows which are supporting these ETF inflows, which in turn is driving their gold price up. Now again, with this war in Iran, if you have to finance a war of this scale, I think there was a number yesterday that in the first 2 days of the war, just on munitions alone, the Yanks spent over $9 billion. Okay, so it's a ridiculous number, and if that continues, over the next 2 to 3 years, the war budgets are going to have to go up, and they're going to have to find a way of financing that. It's either going to be through higher tax rates in the US, which we know the Republicans don't like, or potentially the printing of money, which is a hell of a lot easier to just inflate the problem away. If you're inflating the problem away, it's pretty good support, I think, for gold and for the PGM basket, or the store of value asset class. A lot of people have asked us, it's your bread and butter as Peregrine Capital has traditionally been on the bottom-up stuff, value investors, and how does this sort of fit into your current sort of thinking about the world? Well, a great example of how we play this sort of macro theme is through a company like Pan African Resources. Over here, you've got a very aligned executive team. They've got a lot of shares in their own business. They're growing volumes of gold that they're producing and getting out the ground every year. They've got an unhedged position with respect to gold prices. A lot of other companies are not in the same sort of position. There's been very high returns on equity on the incremental capital expenditure that's going into the ground. And then there's certain technical factors that we're playing here. There's an index inclusion in the JSE that is just about guaranteed to take place over the next sort of 30 days. And there's an impending ASX listing. So for anybody that's looked across the pond in Australia and you see what those resource companies trade at, it's generally at a much higher valuation multiple than what we see in South Africa. So there could be additional support from Australian buyers stepping into the market for a company that has got a very conservative balance sheet and trades on a 7.8 PE, which is still pretty good value at this point in time as far as we're concerned. So we do see the macro overlay as one of the drivers, but from a bottom-up perspective, Pan has been a fantastic business, and we're still very, very optimistic about the prospects for Pan. Then I think to the final theme, what is artificial intelligence? If we had to do a survey across the room, I still think quite a few people are going to put their hands up and sort of refer to these chatbots. Grok, Gemini, Copilot, GPT, and Claude. And I think the message we want to send today is that it's just so much more than these answer engines that we're familiar with. I got back from China in December, and I saw many of these robots not doing these fancy tricks, but fairly scary in terms of what they're capable of. There's these glasses on the bottom left-hand side that, you're going to have this augmented reality experience. You're going to have robots that are sort of available to clean your houses and do all sorts of things in the garden for you. I went in a Pony AI car, which is an autonomous vehicle that sort of took us around the corner, and it felt safer than driving with a human and far easier to interact with, which was amazing. And throughout Shenzhen, there are these drones delivering your meals, which is absolutely unbelievable for me, particularly with these high-rise buildings everywhere in terms of how you navigate that. So AI is powering all of that in the back end. And I think we're moving to a world that is pretty futuristic and looks a little bit more like Star Trek and Star Wars than it does, the current environment that we're exposed to. But the experience is, fairly jagged in terms of the intelligence and how it's impacting various parts of the economy. So for things like computers and maths, for things like business and finance, you're seeing much greater strides that have been made by these artificial intelligence platforms, because it's more deterministic in terms of how these things actually compute in the background. So say, for example, on coding, you use X amount of compute to effectively brute force your way to a solution that can create a software outcome for you in platform that you can build yourself. You don't have to rely on third parties to do that. So the limit is your own creativity in terms of what can be built. Where it's not so good is on things that require a little bit more EQ, and the creative arts and those sort of things, as Danny and I were speaking about earlier. I think that's far more insulated. But anything that's a little bit more deterministic, for an accountant like me, you do worry a little bit more in terms of what your role in the ecosystem is going to be going forward. So where do we see opportunity within the ecosystem from an investment perspective? And from the bottom up, you've got to say to yourself, well, how does this AI manifest? Well, first and foremost, we will see these apps that we use on a day-to-day basis, Gemini, Grok, ChatGPT, and the like. You'll also be interested to know that Google, Meta, Microsoft, and Tencent are also powering many of their applications with AI to provide you with much better targeting from an advertising perspective, for example. But they need massive amounts of infrastructure. They have to create huge data centers that effectively power all of this in the background. And what goes into those data centers is chips, is memory, storage components that are sourced from the likes of TSMC, SK Hynix, NVIDIA, AMD, and Micron, and the like. So we see opportunity throughout the ecosystem, but I think most of our focus is on that sort of application layer and the infrastructure layer, as well as on TSMC a little bit lower down. The question is, there's a lot of news out there in the market at this point in time in terms of this boom. Does it look like 2000? Is this something that should be scaring us? So this is fairly scary. So if you look at the spend, the capital expenditure by the top 7 players in the market at this point in time in the States, it has grown by 62% per annum for the last 3 years. So we're scheduled to spend approximately $740 billion in CapEx this year, and I think there's upside risks to that number. That is a hell of a lot of money, and you'll find that most of these companies are spending the vast majority of their operating cash flow on incremental CapEx. It's a huge, huge number. The natural question to then ask is, are you generating return on the spend? So the first sort of layer we want to sort of zone in on or zoom in on is these cloud service providers. So that's the likes of Azure, GCP, and AWS. And what you'll see is that the net new revenue that's been generated on a quarterly basis, if we annualize that over the course of the last, let's say, 5 years, you've seen quite a significant acceleration over the course of the last 4 quarters, and in quarter 4 especially. So we're anticipating that throughout the course of 2026, those numbers are going to absolutely explode for all of these hyperscalers that we refer to. And the returns that they're getting are commensurate with the capital that they're putting in. There's approximately $76 billion of ARR, average revenue run rate, that's been added over the last 12 months. So that compares relative onto the prior slide of that $700 billion of CapEx we're expecting. There is return, and we would expect that to improve over the next sort of 12 to 18 months. The other thing on the foundation models, which sit at the top, and they power your ChatGPTs of the world and your Geminis, what's interesting here is to see over the course of the last few years, since November 2022, when ChatGPT was first launched, you've seen the amount of capacity expand by 250 times, but the cost per token is now has come down by over 90%. So these chatbots are materially faster than they were at the start. It's no longer just doing things like answering funny questions and generating pictures of cats. It's giving you deterministic outcomes insofar as building software is concerned, and we're seeing that within our business. And I think it's absolutely it's wonderful. It's very exciting, and everybody should really just toy around with these things as tinkerers. So I think we are seeing ROIs is the net sort of message there. And then, are we overspending? Is that $730 billion too much money? Are we going to have a situation where these companies blow their balance sheets up? And I think an important bottleneck within this ecosystem is TSMC. So for those who don't know, TSMC is the company that has got like a 90% market share of these leading edge chips. They are basically a monopoly in the world. They are currently increasing their capital expenditure in this slide on the bottom by a much, much lower rate than the rate of increase that we've seen by the US hyperscalers in terms of what they are spending. So what is the message we're sending there? TSMC is simply not spending enough money to keep up with the demand on the other side. So even if these US hyperscalers wanted to spend more, they're going to be limited by TSMC. And if you go back to the previous picture, they are the bottleneck. Everything needs to go through TSMC, and we love owning monopolies at 20 times earnings. So I think it serves two functions. TSMC is both a fantastic investment opportunity on its own, outright, but it's also preventing all of their customers downstream from spending too much money and blowing their balance sheets up effectively. So then what about valuations? Everyone's comparing this to the year 2000. Does it look similar to that period? And I think on the right-hand side of the slide, we just wanted to get the message across that, in the year 2000, the forward multiple on the NASDAQ was 2.4 times higher than where it is at this point in time. These companies are all generating tons and tons of cash flow, of real earnings, and we simply don't see it as being remotely comparable to anything that we've seen over the last sort of 20 years. So we remain quite bullish and optimistic about the prospects for these companies, and AR remains a key theme insofar as our portfolios is concerned.